Welcome everybody to this Rankia Pro interview. Today we have the pleasure to interview Kathy Wood, Chief Investment Officer at ARK Invest. With more than 40 years of experience identifying and investing in innovation, Kathy Wood created ARK Invest to focus only on disruptive innovation while adding new dimension to research. As CEO and portfolio manager, Kathy led the development of ARK's philosophy and investment approach. Good afternoon, Katie. How are you?
I'm doing very well. Great to meet you, Teresa. Thank you for inviting me.
Well, we are very glad that you are joining us today. Now, let's start with this interview because we have a lot of interesting topics to talk about. The first question is, how would you define the vision and the mission of ARK Invest Europe?
Yes, ARK Invest global, but Europe, because we've just entered with our own funds, our own UCITS ETFs. Our mission is to help asset allocators gain differentiated exposure to innovation in the form of truly disruptive innovation. And we don't think enough research on the 5 major innovation platforms around which we have centered our research is taking place. So the 5 platforms are robotics, energy storage, artificial intelligence, blockchain technology, and multi-omics sequencing in the life sciences space. So the first reason I started the firm was to focus exclusively on disruptive innovation. And then the second reason was to really create an open source research ecosystem whereby we give our research away on social media and basically we've become the first sharing economy company in the asset management space when it comes to research. It's created tremendous dialogues between our analysts, whose responsibilities are broken out not by sector or industry, but by technology. And so they are meeting people through social media that I think would be very difficult to meet as a traditional financial services firm.
That was very interesting, Katie. Thank you so much. Now, related with what you just said, a lot of investors would like to know what specific criteria do you use to identify disruptive technologies worth investing in?
Yes, there are 3 major criteria. The first is that these technologically enabled platforms they follow a learning curve. What that means is that costs fall over time the more units of a given technology are produced. And so we try and measure what is the rate of cost decline for each of the technologies. So very important that costs are falling, opening up the technology to more and more industries and sectors. The second criterion is just that they are cross-sector, meaning they're going to scale not just in one sector. So take DNA sequencing or multi-omic sequencing, for example. Sure, that's very related to healthcare, but it's also very related to farming, so animals and plants. And all of the new technologies coming out, gene editing technologies to make crops better and to yield higher yields with less water, that sort of thing. So scaling across sectors is the second characteristic. And then the third is that these technologies, innovation platforms, are launching pads for more innovation. So a good example there, again in the multi-omics space, is if we could not read a person's code, we have 6 billion bits of code in our genome. If we were not able to read what was going on, in other words, sequence the genome, and find out what was going wrong, what was mutating, we would have no invention like gene editing. If we couldn't find the gene, there would be nothing to edit. So gene editing, CRISPR-Cas9, is a new technology that has been born out of the multi-omics sequencing platform.
Well, we just talked about really, really disruptive technologies, and my next question is related to that. Given that ARC invests in companies from emerging sectors without clear comparables, but with potential, tell us, how does ARC approach the valuation of said companies?
Yes, so we have a 5-year investment time horizon. That's very important to understand. And so for most of the companies in the portfolio, with the exception of some in the multi-omics space, which that's very early stage, we believe they will all reach profitability. We've got lots of profitability now, but we've got companies that are sacrificing short-term profitability, investing aggressively in R&D in order to really take the lead in some of these winner-take-most opportunities. So we do believe, however, that they will reach profitability, and our chosen valuation metric is enterprise value to EBITDA. So enterprise value is taking into account the entire capital structure, so equities, fixed income, and so forth. EBITDA, we're avoiding games associated with EPS, especially financial engineering with share repurchases and so forth. So enterprise value to EBITDA. Typically, our portfolios, our companies in our portfolios, therefore, are selling at a premium, and sometimes a significant premium to the market in the short term because they're sacrificing short-term profitability. But the assumption we make in our valuation is that valuation premium shrinks to a market multiple over 5 years. So that's a headwind that all of our stocks are facing. And as analysts and portfolio managers, we have to believe that revenue growth and margin expansion is going to overwhelm the valuation compression and deliver to us a compound annual rate of return of 15% or more. Now, I'll just say something about that. Our compound annual rate of return of our flagship strategy has been 10% over the last 10 years. So we have not achieved the 15% yet. However, we were achieving it before the Fed shocked the global financial system with a 24-fold increase in interest rates. We had never seen that before. Now we believe interest rates are going to start coming down, and we will catch up over time to that 15%, and we think exceed it noticeably over time.
Well, those were really valuable insights, Kathy. I want to talk also about the star of the show, which would be artificial intelligence. Now, how can investors be sure that artificial intelligence is not a bubble?
Well, based on our analysis, again, top-down analysis and bottom-up analysis, we believe that AI is the most disruptive technology in history, and that we are in such early stages. We are in internet years, we're in the early 90s. So or maybe even earlier. We think it's going to transform every sector, every industry, every company, and that companies not investing in artificial intelligence will lose out competitively. Now, despite saying that, we do see in the private world, in the venture capital world, there has been funding of companies without any products yet. Just they're very talented computer scientists and AI experts who have an idea. That is a little bubble-like, but that's also what venture capital does. Venture capital expects a lot of failures, but they expect their successes to overwhelm the failures. That's not a bubble. That's just how venture capital works. In the public equity markets, you might say NVIDIA hit perhaps a little bubble territory, because we do think there's going to be competition, including from its biggest customers. And we do think there's been over ordering, so double and triple ordering of chips because they were so hard to get for so long. And so that will shake out as well. But that's going to be minor. It's not like the tech and telecom bust, which lasted a full 3 years, back in the early 2000s. We don't think it's anything like that.
So you just stated that artificial intelligence might be the biggest disruptive technology ever. So I have to ask you, what are your favorite AI stocks at the moment?
Well, this is where we get into the undervalued and underappreciated part of the market. Um, Tesla is our largest position, and we believe that Tesla is running the largest AI project in the world, and that on October 10th, when they debut their robotaxi and give us more information about timing, that more and more analysts will start modeling out what autonomous technology is going to mean for Tesla. It's going to turn Tesla's gross margins from the mid-teens, where it is right now in the electric vehicle space, uh, into 50% plus, because uh, autonomous taxi platforms are SaaS platforms, software as a service platforms. Software as a service, it's alone has 80 to 90% gross margins. Electric vehicles have 15 to maybe 30% margins. When analysts start modeling out what AI is going to do for Tesla, they'll understand that it is the largest AI project in the world. The other company that we think is extremely important, of course, NVIDIA is important. I'm not saying NVIDIA is not important, but AMD also is producing chips and has gone from 0 to 4 billion in sales in a year's time. That's huge, in AI chips. NVIDIA is at roughly 100 billion. So AMD on that basis, 4%, but it's scaling so quickly. We do think it represents important competition to NVIDIA. Then the other one is Palantir. Palantir is a software company with gross margins in the 80s. Many people think Palantir is a consulting organization. Consulting organizations typically have very low gross margins. There's a lot of labor intensity in them. Palantir is a software company, and what it is doing is preparing large enterprises for AI. It is first getting them to bring together the data from far-flung parts of the world, clean it up, integrate it, map out workflows in excruciating detail. And then what happens is Palantir's operating system will sit on top of whatever other technology a company has, like Oracle or SAP. They don't have to rip those out. Palantir just sits on top of those, and anything at the margin takes place in Palantir's operating system. We think it's one of the most important AI companies out there. It's about $75 billion in market cap. I think Microsoft is over $2 trillion. Alex Karp believes that Palantir will be the largest pure play AI software company in the world. So yes, Microsoft, it's $3.2 trillion. Palantir is only $75 billion. So it has a long way to go if it's going to be the largest pure play AI software company in the world. That's what Microsoft is trying to achieve. It's going to be difficult, we think, longer term with a lot of legacy software in enterprises. Palantir is going to sit right on top of that.
Thank you, Katie. Now, my next question was a little related to that. I wanted to know which sectors do you believe are currently undervaluated by the market? And of course, on the other hand, are there any that are overvaluated?
Yes, we think that in terms of undervaluation and in terms of our strategies, by far the most inefficiently priced and undervalued is the multiomics revolution. It got hit the hardest by interest rates going up. They are in early stage, so they are probably many of them are burning cash. They have good cash cushions because the market has forced them to raise funds, but in order to remain safe, basically viable. But they are investing aggressively now. If you have a 5-year investment time horizon, by far that is the most undervalued. And I would say within that space, CRISPR Therapeutics and Intellia are two CRISPR-Cas9 gene editing stocks, and we're already seeing approvals. US, UK, Europe for CRISPR Therapeutics gene editing strategies for sickle cell disease and beta thalassemia. They're curing people with those diseases when before there weren't any therapies even to treat the symptoms, so except for blood transfusions. So massive opportunity there. And very undervalued at only $4 billion in total market, in enterprise value, I should say, enterprise value. So in terms of overvalued, I would say that the mega cap tech companies run that risk because I'm not sure how highly publicized it has been in Europe, but if you look at the Magnificent Six, take out Tesla and look at the Magnificent Six. So that would be Microsoft, NVIDIA, Amazon, Apple, and there are two more that are not readily coming to mind. But those have dominated market performance in the last few years. And if you look at concentration in the marketplace, based on a recent Goldman study, we have never seen a more concentrated market. If you use the top market cap stock divided by the 75th percentile market cap stock, we've never been more concentrated. That tells me there's a lot of risk in those names, especially if, as we believe, some of them will be disintermediated or disrupted by AI. Google or Alphabet is a good case in point. Its advertising model is at risk because now we don't have to click on links to find answers. They're starting to give us an answer right away because ChatGPT has forced them into it. So if you don't click into a link, there are no advertising dollars to Alphabet. So it's got innovator's dilemma. What does it do? It has some of the best AI talent in the world with DeepMind, a company from the UK that it bought, but it can't harness it the way it should because it will disrupt its advertising model.
Very interesting, Katie. Now, it is time to talk about something a lot of investors have been worried about for the last month, which is volatility. Now, how do you manage the friction between short-term volatility and your long-term conviction in ARK Invest?
It's a great question. Disruptive innovation, especially during uncertain times, is very controversial. I'll give you an example. In the early days of Tesla, GM, Stellantis, Ford, Mercedes, Volkswagen, all of them dismissed Tesla. They made fun of Tesla lining the bottom of its cars with cell phone batteries, effectively. But that was brilliant on Tesla's part. and what many people thought was impossible from an engineering point of view, Tesla accomplished. So what happened during especially 2000, well, from 2014 when we started the firm through 2000, most of 2019, there was a huge trading range around controversies. And when one controversy was answered, the stock would go up, and then another controversy would show up, of course, planted by the incumbent auto players or the analysts out there who were supporting the incumbent automakers. So we were in a huge trading range. It was 100% trading range, from peak to trough. And then in 2019, it broke out. So what we did during that big trading range is when it was at the top of the range, we took profits. When it was near the bottom of the range, we bought. And we did this. And we added alpha during that period. Now, are our portfolios volatile? Yes, they are. We don't make any secret of that. But volatility on the upside is a very good thing. And when in 2019, when Tesla broke out, we were ready for it. Even though we had Trimsun at the top of the range, it always remained our top stock in the portfolio.
Well, we just talked about volatility. Now let's go with another important topic, geopolitics. Considering the current situation, what impact does geopolitics have on your global investment strategy?
Yes. During tough times, innovation gains more traction. That's a surprise to people. Why is this? Innovation solves problems. We have a lot of problems. Innovation tends to bring solutions that are faster, cheaper, more efficient, more productive, more creative in terms of new product rollouts. And so when times are tough or when businesses and consumers are scared, they're willing to change their behavior. During good times, it's hard to get consumers and businesses to change their behavior. During tough times, and I think we can categorize today as tough from an economic point of view and from a geopolitical point of view. During tough times, innovation actually gains traction, accelerates.
Well, we are almost at the end of this interview, but let me ask you first, how does ARK Invest handle the regulation of technology markets that is always growing?
Yes, regulation is part of our scoring system. We have a 6-metric scoring system, and thesis risk is one of the scores. Thesis risk is a question we ask about each one of our companies. What could go wrong? And regulation is usually at the top of the list. And so I'll use regulation in conjunction with autonomous mobility, for example. In our early days of research, 2014, 15, we thought the thesis risk associated with autonomous mobility was very high. Regulators would have a lot to say about it. What happened, interestingly, over the last 10 years since that case is after declining for years and years, auto fatalities, so deaths in auto accidents, started moving up, they were cut in half, more than half, from the 70s through 2014. And then over the next 10 years, they moved up by 50%. What was that? That was young people disproportionately using texts and getting distracted in cars. So regulators are now looking for solutions to that problem. And Tesla can prove that its cars are, I think they're 16 times safer than the average car on the US road. Just to put some color on that, this is our research. The average car on the road in the US has an accident every 200,000 miles. The average Tesla with FSD, and not the latest full self-driving, but the one from 9 months ago, has an accident every 3.2 million miles. 200,000 versus 3.2 million. Now, that might be hard for people in Europe to believe, because their European regulators have not allowed FSD, full self-driving, in Europe like they have in the United States. So I think that the safety data that is coming out will migrate to Europe as well. And we think the regulators will lighten up. So we think the thesis risk associated with autonomous driving has gone down in the 10 years. And that has helped us increase our position in Tesla to the highest position in the portfolio.
Okay, thank you very much, Katie. Now let's go with our final question that really is about ARK Invest as a whole. How do you expect innovation to help remedy some of the current economic challenges?
Yes, I think robotics, what is it going to do? We have a major demographic crisis in the developed world. Europe, China, Japan, and increasingly in the United States. And so we need robots if we're going to continue growing. And we think with robots, the growth rate of the economy will accelerate as the productivity of human beings increases, as they oversee collaborative robots. So that's one thing. Energy storage. We know that the oil price increases of recent years have been a terrible tax on the consumer, and it's a regressive tax. It hits the poor much harder than it hits the wealthy. So we think the move towards electric vehicles and electric transportation of all kinds, including drones and air taxis, is going to probably means we saw the peak in oil prices in 2008, and the recent rise and now fall will continue from a secular point of view. In terms of healthcare, in the United States, and I know we're much worse than in Europe, but in the United States, roughly 20% of our GDP is healthcare. In Europe, it's less than 10%. In the US, because our society is so litigious, there are so many lawsuits, doctors, they prescribe drugs and order surgeries just to be safe. And we think more than half of the healthcare dollars in the US are wasted. With sequencing, we'll be able to be more precise with science. Now that we know what's going wrong with the human genome, we can sequence the human genome and see where the programming errors are in our bodies as we age. That means we'll be able to move towards what many people in the late 90s called personalized medicine. It is going to happen now because sequencing costs have collapsed. They've gone from $2.7 billion for one person's genome 21 years ago to $200. So it's going to proliferate in the years ahead and help us become much more efficient in terms of healthcare. In terms of AI is going to increase the productivity of knowledge workers by 4 to 5-fold. Can you imagine doing 4 times or 5 times the amount of work you do every day? The output? Imagine these videos. You do 4 to 5 times more each day or each week in 5 years than you do today. And you're not any more tired. You've got AI enabling you and helping you. That is going to generate tremendous wealth and profitability, which will be shared with the workers. And then finally, in blockchain technology, you can call it, and I heard this from an investor in India a few weeks ago. the finternet. It's the financial internet. What's happening with blockchain technology is we're developing the layer of the internet that was never built in the early 90s because no one knew financial services and commerce would take place over the internet. So it is going to get rid of that 1.5% to 4% tax on every transaction, we think caused by credit cards and debit cards and other intermediaries. So it's really going to be transformative. All of these technologies are going to transform our lives in a way that we think is going to make the world a better place. And that's one reason I started ARK Invest.
Thank you, Katie, and thanks to all of our viewers. Remember to follow us in our social media and subscribe to our newsletter and to our magazine. See you very soon.
My great pleasure, Teresa. Again, thank you for inviting me. And we're really looking forward to meeting more and more people in Europe as our portfolios make their way throughout Europe. So thank you so much.